So basically, very simply, I'll tell you how we look at sovereign risk, how we rate countries, and then basically 2 to 5 will be more of a reference on Moldova itself. 6 we can ignore because that will be done at the end. So how does Moody's rate sovereigns? We actually have a basic benchmark which provides guidance. It's not some kind of system whereby you put A, B, C in and get X, Y, Z. It's a sort of a generic mix of different factors which cannot be necessarily quantified. But this framework provides us with a basis for guidance across countries. And one thing that's obvious, when the discussions on other countries were taking place, by the other panelists was taking place, it's actually, in a way, we shouldn't look at countries, in fact, based on just the country in isolation. The attraction is always going to be relative. So one of the things that, with policymakers, for example, that makes adjustments possible is to actually focus on what other countries are doing. And so to look at a country in isolation, I think is actually not always the right thing to do, because you have to actually look at what foreign investors are looking at in other places, not just in your own country. Having said that, basically, when we sort of rate a sovereign, looking at the 4 at the top is basically what I'll be focusing on. Economic strength. There, we will look at things like economies of scale, the extent of diversification, GDP per capita. Now, the focus of this is to provide some kind of analysis on the ability of an economy to absorb shocks. So you'll find that, generally speaking, an economy that has a high GDP per capita and is diversified, if there is an external shock, it doesn't suffer as much. During the global crisis, the whole global system suffered, and the more integrated the country was to the global economy, there were issues. But generally speaking, you did sort of see various levels of resilience, and the more diversified the economy, whether that's geography, the type of products that are being produced, you will see more resilience the greater those are. In terms of the sovereign, that also then has an implication for revenues and whether there's need for fiscal stimulus. So from our angle, I've given you the sort of things that investors will generally look at, but from our angle, this is what the end product is. Basically, governments then have more ability to capture revenues if the economy is not going from -3 to +5. It also provides you with a sort of stable source of revenue. Now, institutional strength. This is actually, I think, one of the key ones for Moldova, and it's also been the underlying theme that's been taking place. What we would look for here would be, how does the central bank operate? What is its mandate? What is its effectiveness? This applies to the Ministry of Finance, whether you're talking about how tax policy proceeds and things like that. That again has an implication for FDI, because if you have a stable mandate from the key policymakers, it then makes a difference in terms of the confidence of investors, whether that's for sovereign debt or for FDI as a whole. Within that actually framework, we will look at, other people have also already mentioned, for example, the World Bank. So, it does actually provide a general framework where we'll look at indicators released by Transparent International and the World Bank to sort of provide a basis for what we're looking at as a secondary source on top of our own analysis. Again, these are things that FDI investors will be looking at as well, just to see what is the attractiveness of a certain institutional framework. I'll be mentioning that again quite a few times within the context of the other slides for Moldova, so I'll skip on to financial strength. Here we are looking at what can have an impact, and these are all bearing in mind related economic indicators. So where you have economic strength, that will actually help the financial strength of the sovereign. So when we look at these, we'll say, okay, is the possibility to maintain revenues there, going back to the stability of the economic growth environment? What is the ability to expand the revenue base? This has an impact, in fact, on FDI. If investors think that a government has issues, it may have to then change its tax policies. That can actually then come back, and suddenly you'll see a change in what foreign investors assumed, and all their investment assumptions have to change. So these factors are all interrelated. But more generically, for the sovereign, we will look at things like the maturity profile of the debt. Is it in foreign exchange? Is it domestic? In Moldova's case, again, I'll be hitting on this later, but the fact that there is no domestic capital market that can properly absorb long-term bonds, and there is no external demand for longer-term sovereign bonds. These are all issues that we would look at in terms of the strength of the government. Can expenditure be cut? Is there a resistance at the social level to anything in terms of current spending? If there are social tensions, that can have an impact on what the government can and cannot do. And finally, risk susceptibility. This captures a myriad of things, and this is very much the part where it's very difficult to defend or not defend a certain rating because there are so many general factors at play. And what specifically in terms of risk susceptibility, we will break it down into economic risk, which looks at volatility and the structure of the economy and whether it can absorb shocks. Financial risk, looking at the extent of shocks in general, stemming from whether that's the exchange rate, foreign markets, or the domestic banking system. And finally, political risk, which has an overarching impact on everything. Now, if you notice, a lot of these are interrelated because they will be summed up that each of the first three sections will have some element of risk, and we sort of try to capture that in the fourth indicator. Yeah, okay, so within the context of Moldova, I've got 2.5 minutes. Now, what we saw here is during the boom period, for the global economy, Moldova actually did fairly well. Coming out of the 90s, it did actually manage to grow at a fairly decent rate. And just like the rest of the world, in a lot of cases, we saw a very considerable collapse in economic activity. But Moldova, to be fair, it did actually see a V-shaped recovery. Again, this actually seemed to be a lot to do with the fact that remittances didn't collapse abroad, and actually during that period the euro area hadn't started seeing the volatility that we saw from 2010. But basically, if you look at the projections that we have, we do not expect growth to recover to the levels that was there 4 years ago or 5 years ago. Now, this, going back to one of the points that was brought up in terms of FDI, as an attractive market, will this be an export-driven FDI boom, or will it be domestic? If I look at this, the demand from the domestic market will be actually quite limited going forward. And this is not just to do with issues in Moldova. This is the fact that the EU area, which is the main market, is going to remain weak for a number of years. And at the same time, we're not going to see the sort of global GDP output trends that were there from 2001 to 2007. And for a very long time, because a lot of these external markets are still deleveraging, and that's not a slow process. And that actually is bringing me on to the one slide that is sort of connected to what everyone else has been mentioning in this session, is the fact that we do see the fact that the trend in domestic investment, which happened during the boom time, was in part driven by FDI, but going forward, our forecast is that actually it will remain relatively weak. Now, this is a combination of the structure of the economy, the amount of liquidity and the easy money that was around for, available through investors isn't going to happen again. It's a very different sort of, we hear on the one hand that there's a lot of liquidity, we're hearing that investors are chasing yield, but actually they're chasing yield in financial assets where they have liquidity, they can get out of the markets. The trends in FDI will probably be different. We're not going to see the kind of peaks that we saw from 2001 up to 2007. I'll just skip that. Right, so basically, this is a summary of Moldova in the sense of what we would look at in terms of institutional factors. Again, this is only one aspect of what we will look at in terms of institutional strength, but again, these are underlying trends which will apply to investors in sovereign bonds and in FDI and other asset classes as well. Government effectiveness, accountability, corruption, all of these issues are important to investors. They've been mentioned on other people's slides, but in a different way. But effectively, this is the basis that we will use to sort of at least have an idea that we're going in the right direction in our analysis, is to look at these indicators as a whole. And basically, if you look at Moldova, it's sort of comfortably within its B rating class, but depending on which area of this web diagram you're looking at, there are other countries in the region which actually do better. Okay, financial strength. This is the one positive, and like I said earlier, we do look at a lot of factors when it comes to the financial strength of a government. I mean, this is actually a very, very positive scenario. We are seeing the budget deficit is quite low. The recovery, because of fiscal consolidation, is very apparent there. We don't expect a continued improvement, partly because of the low GDP growth outlook, but there's only so far also fiscal consolidation can go. They could not have carried on at that trajectory. But generally speaking, as you can see, there's actually been an improvement, even relative to its peers in the same B group. Having said that, nominal GDP growth has been very strong, so what you've seen is an improvement in the general government budget debt stock relative to GDP. That's actually, like I said, to do with the denominator as much as anything else, but there have been efforts to control the government debt stock. Having said that, look at the actual profile of the debt stock, and it's actually basically concessional or short-term debt. That is actually one of the weaknesses that we see, is the lack of access to global capital markets and the lack of developed local markets. And that's one of the points that David brought up, is that actually if the resources are available in the domestic economy, but there is no functioning market to provide those resources, that will be an issue for the government as well as private investors. I'm almost there. Last slide. Basically, so this is like a summary of a lot of things that a lot of people have said, and I've already sort of mentioned, so we can very quickly do this. As I said at the beginning, the three factors that we looked at in terms of susceptibility to event risk come under political, financial, economic. What we are looking at in terms of Moldova is one of the key drivers in terms of investment and confidence is the volatility in the domestic political scene. Between the parties, within the alliance, these factors have an impact on how foreign investors, regardless of what they're investing in, how they will view Moldova, and in terms of the ability of the government to deal with the problems that the economy faces. Because if you don't have a functioning parliament, it's harder to actually carry on functioning with policy, and the bureaucracy itself isn't at the stage of institutional development that can actually compensate for the problems in parliament. The economy, already people have hit on this. You can see this as a positive or a negative. But the fact that the economy, 25% of GDP remittances. That's an issue when you're looking at Russia. Basically, if something happens in the euro area and Russia, there could be big problems in terms of remittances, and therefore that has implications on Moldova's private consumption and the ability to sustain its current account deficits. So those two factors all work out very closely. People have already mentioned the positives of the fact that there are remittances coming from Russia and the EU. We do have EU funds, the potential for a free trade agreement. But those very positives are also creating the tensions between the dynamics within this economy between Russia and the EU. So those are causing progress on reforms in some areas are actually causing to slow down in others. And finally, hitting on the financial system, this is where we are relatively positive, but for a negative reason. The lack of integration into global capital markets means that actually if there is contagion risk across the world, Moldova actually doesn't suffer very much because actually the system is not integrated with the banking system abroad.